Welcome back to accounting. It's a wonderful day in Troy. It's a wonderful day in the neighborhood. And it's Managerial Accounting Day. Always an exciting day. What I'd like to do is spend a little bit of time talking about managerial compared to financial, compared to what is it that firms do anyway with respect to accounting. So here we go. I have a few announcements, but I want to start with just some generalities about financial managerial and stuff like that. What we have done so far is financial accounting. And financial accounting, the key to financial accounting is something called GAAP. So before we start talking about managerial anything, we need to talk about GAAP. What was GAAP again? And why do we have GAAP?
Generally accepted accounting principles.
Generally accepted accounting principles, and they are designed for reporting. Reporting what to whom?
To the government for taxes.
Okay. For the government for taxes, the answer is not exactly. Mostly, I mean, you're 80% right, but not 100% right. Okay? But so GAAP is designed for reporting something to somebody. What's the something and what's the somebody?
Earnings to stockholders.
Okay, what are the statements that get published every year? Okay, so GAAP, the SEC requires that every company every year who is selling stock over any American exchange must publish a number of statements, right? One of which is an income statement, a P&L, right? Profit and loss, an income statement. 2 is a balance sheet. 3 is a cash flow statement, which you now know how to do since we did it last time. Some minor statements include a statement of retained earnings, or reconciliation of retained earnings, including dividends declared, things like that, and a few others. In addition, every time one of these things is published, it includes what are called the notes, the financial statements. Now, what are the notes to financial statements? They are simply a set of notes which accompanies the financial statements, and it's in the notes where all the skeletons are buried. So the point I want to make right now is that if you're analyzing a company, you're thinking about either buying their stock or working for the company or doing whatever, and you're going to do a financial analysis of that company, you want to spend a considerable amount of time reviewing the notes. And the notes include things like what? Things like leases. It turns out leases is quite the accounting game. Yet much of the truth with respect to leases appears in the notes, does not appear in the financial statements. Another big ticket item are contingencies. Contingencies. What are contingencies? What do I mean by contingency?
Like if there's a risk, that's like Plan B.
Okay, risk. What are the big risks to most corporations?
Lawsuit.
Lawsuits, exactly. So that's where you go and you find out who's suing whom and for how much. It's buried in notes. Does not appear anywhere in the income statement, balance sheet, anything else. It's buried in the notes. Another hot topic that has lots of juicy junk dangling from it is called pensions. Pensions were a fat topic a year and a half ago, right? With the NASDAQ going down by 2/3, all of a sudden pensions have interesting problems, right? Because they need to be funded. And how they are funded is a very interesting game in accounting. And so the point being that in financial accounting, we have these generally accepted accounting principles. It controls how we create these statements and how we create the notes. And these statements and notes are being delivered to whom? To stockholders of record, to prospective stockholders, and or to banks. So the key thing to understand about financial accounting is the reason we do financial accounting is because we are going to present information to outside individuals. And those outside individuals are primarily stockholders, actual or prospective, and or banks. Now, very similar to GAAP financial accounting related information is tax information. And who controls tax information? Go to the next page. Who controls tax information?
Government.
And the answer is the government, the IRS, right? So the governing body is the IRS. And the rules here are just like the GAAP rules. They make the rules, we figure out ways around the rules. Right? And it's a very simple game in theory. It's a very complex game to do well, right? But our goal in tax accounting is to minimize our tax liability, right? Our goal in GAAP accounting, if we're a good CFO, is to do what? What's our goal? Maximize what?
Earnings per share.
Maximize earnings per share. That's our GAAP goal. So what we do is we follow the GAAP rules, right? But we choose those rules that allow us to give the most favorable earnings per share presentation that we possibly can. Now, higher doesn't necessarily mean better, but you know, high is good, right? We want this number as big as we can get it. Now we move to taxes, right? The goal in taxes is to maximize what? Cash flow by doing what? Minimizing tax liability. That's right. And this is a different game. And as we spoke in the past, there are many situations where what we do for tax and GAAP are going to be the same. All right? So here's where tax and GAAP, we must use the same rules. What's an example of that? Inventory. Whatever inventory method we choose for tax, we must use the same for GAAP. Right? We use the same accounting policies, rules and regulations. However, there are other areas like depreciation where the rules are different. Right? So this is our different category. For depreciation, we can use, for tax purposes, we use MAKERS, which is accelerated tax depreciation. And yet for GAAP, we use straight line depreciation. Now you think about that's interesting, because we get to use different accounting methods, one for GAAP, one for tax. So we choose the method for GAAP that lets us do what? Maximize earnings per share. We choose a method for tax that allows us to minimize net income, maximize cash flow, and minimize the amount that we're going to give to the government in the form of taxes. This is all part of financial strategy, which has been the first, in theory, the first 7 or 8 classes, but since we've had some follow-up in the semester, been basically 3/4 of the semester. Questions about that? Does that make sense so far? So again, the game is what? They make the rules. We try to make use of the rules in our presentation of our tax information to the government and our financial information to our stockholders and various other external bodies. Now another one where there's different is bad debt expense. And with bad debt expense, we're on an accrual method for GAAP. But for tax purposes, we're on a cash basis. What the heck does that mean? What that means is, for GAAP purposes, we use the bad debt expense calculations that we learned in class. So what we learned was the way to do it with respect to GAAP. However, we use a direct write-off method for tax purposes. So even though we take the expense in year 1 for GAAP purposes, we don't get the tax expense until the next year when we actually write off the bad debt. In other words, there's no estimating. There's no estimated bad debt expense for tax purposes, but we do estimate it for GAAP purposes. Again, does that make sense? But again, they make the rules, we figure out ways around the rules. Now, how does that differ from managerial accounting? In managerial accounting, there are no rules, which in a lot of ways is the great thing about managerial. There are no rules. So what are we doing? All we're doing is we're trying to collect information that helps us make decisions. Let me say that again. We're collecting information, obviously accounting-based information, but not exclusively. We're collecting information to help us make decisions. Now, as it turns out, that what most firms do, the data coming in to the system, right, runs through a filter, and most firms use GAAP-related or GAAP kinds of things to collect information. But it turns out that it's collected at such a low level that you can then take GAAP information and do the financial and tax from this basic, and it's just a database, right? And if we take the same basic information and reorganize it, and that's what managerial is all about, we reorganize very similar information. We take the same database and reorganize this thing. Now we have managerial. Now, the point here being that the statements that we create for GAAP in general are not very helpful for management. They're not very helpful for ongoing managerial decision making. Right? The GAAP rules are designed with one person in mind. Who's that person? The external reader of the statement, the stockholder. So it's designed to give the stockholder a reasonable idea of what's going on at your company. Managerial information, does the stockholder ever see managerial accounting information? And the answer is no. This is information that's generated internally, kept internal to the organization, and so they cut and slice the basic data set in many different ways in order to help managers get a look at what's going on. Does that make sense? Okay. So today's class, we're going to start talking about managerial. And we're going to start out with Chapter 32. So between now and when I start, I'm going to do a few odds and ends between now and then. Understand we're going to start with Chapter 32, then go to Chapter 31, then go to Chapter 33, and if we have time, 34 in today's class, which I think we probably will have time. Now, let me also forecast for you what I expect will happen over the next few classes. We have but 3 classes to go. Okay? And so, Class 1, Class 2, Class 3. Today's class, like I said, my expectation is we're going to do 30 chapters in my notes, 32, 31, 33, 34, maybe a little bit more. Then on the next session, my expectation is we'll finish 35 through about 39. The last class, we're going to be doing probably chapters 40 and 41. In addition, in the last class, we're going to try to do 2 cases. One case is called Camelback. And Camelback is a case that was included in the case packet that you received. It's a fairly short case. Of the 4 cases that I asked you to buy, it's by far the simplest case and the easiest to analyze. So we're going to take some time in the last class and analyze Camelback. This will help you if you choose to do the case write-up on Destin Brass, which I'll talk about in a second. Okay. I'm going to have, maybe not, we'll see how it goes between now and then. I'm thinking of adding another case. It's a case that I have partially written. I've taken a case that somebody else wrote, freely plagiarized the basic ideas, but downsized it from 8 pages to 2 pages, and then put Boylan Manufacturing on it, disguise and protect the innocent people such as myself, right? And if I get that thing finished and it looks good enough for public consumption, we'll use this case, and I'll show you, and this case is designed to let me use Excel, basically. So it's designed with Excel in mind. And so we'll take a look at that case if we have time. So in terms of your preparation, it is my expectation that we will finish chapters 31 to 41. So all the notes you have, my best guess is we will make it through all of those chapters. However, what we will not be able to do relative to the syllabus is we will not have time to spend 2 classes just working on cases. We're going to spend some time on Camelback, probably a half hour, 45 minutes, hopefully some time on another case that's much simpler than the other cases, much shorter, in that sense simpler, than the other cases that I asked you to buy. Any questions about that? Does that make sense in terms of the schedule? Now, let's talk about the grading and whatnot. What I think I mentioned last time was that I have decided it does not make sense to have the second project. So the 3 opportunities you have are midterm, the project, and the final. So you now have 3 different opportunities, and I will weight these, in other words, we have 10% that is kind of gone away, and I will throw that 10% on any one of these things that you do that you have done the best on. So I will weight it any way that gives you the best grade. A few more announcements. 1, my expectation is that we're going to send out the answers to the final probably tomorrow or Wednesday. Now, anybody who has questions about how it was graded should then, once they have reviewed the answers, should then take up your questions with Sanjay. Only because he's the guy who actually graded it, right? And he's going to be able to tell you what he thought you did wrong. Now, I had some people come to me in class or in my office hours today say, look, I think this is the right answer, but I got half off for it. And I looked at it, and sure enough, it was the right answer, and it was incorrectly graded. Now, everybody incorrectly grades some things sometimes. This is not to say anything disparaging, but I think Sanjay did a great job grading. But, everybody makes mistakes. Plus, it's hard to read some people's writing sometimes. So even though they may have had the right answer there, they disguised it so well that it was impossible to pick up. So if you have any questions, first go to Sanjay with any questions you might have. And if you're running into a brick wall, you still think you're right, he says you're wrong, come to Bob. And then we will figure out the final negotiation. And so the most important thing, in my opinion, however, is to make sure you go through the answers and understand the questions, understand how to do the problem. Because you're going to see 4 or 5 of those questions from the midterm on the final exam. So make sure you go through the midterm and you understand line and verse of how to do those kinds of problems, because you're going to see them again. Okay. Second thing is projects. If you did poorly in the project, you have the opportunity to resubmit your project. However, you should be aware that the maximum grade you can get second time around is a B. And for those of you who got obviously a C or worse, if you choose to, you can rework your project, and you're welcome to send an email to either Stacy or send an email to me. Again, this is BB. And I will try to help you understand what was missing from the first presentation in hopes that you can then redo it, figure out what you did wrong, and then send back a better project. Now these things should be sent to Stacy, right? So the final project, no matter how you decide to get the information to complete it, it should be sent to Stacy. And again, her email is WITASS, unfortunate email, at rpi.edu. Does that make sense?
If we got a B on the project, is there a way we could get a better B by reworking the project?
No. That's just to keep the administrative costs down. And frankly, the project is not the make or break in the grade. You know, so it's more to make sure everyone gets it than it is to bump you up or back or whatever. Questions so far? Third announcement. And that is, you have an optional extra credit. Opportunity. And that extra credit opportunity is one of the cases in the packet that was originally purchased called Death and Grass. Everyone should have received an email to this effect, but I thought I'd explain a little bit more about my expectations if you decide to do this, and how it will be graded and stuff. Okay, here's the first thing. What do I want to see? What am I looking for? Should you decide to do Death and Grass? What do I want? And what I want is, I want a half page where you describe the problem. I like a half page of an executive summary. And then I'd like 2 to 4 pages of analysis. And my suggestion to you is to attach Excel sheets, because this is something that lends itself very well to using Excel. Let me say it again. What am I expecting? I'm expecting something between 3.5 and 5 pages. Right? I want a half page on, as concise as you can, to tell me what the problem is at this company. The executive summary obviously tells me your conclusion. In other words, the problem says this is the problem. The executive summary says, well, this is the answer, in essence. This is what they should do, in a nutshell. And then your analysis explains why you think what you thought and why you wrote what you did. Questions about that?
Is the Excel sheet going to be, is that included in our 2 to 4 pages, or is that like we do the analysis and we say, see this Excel sheet for extra data?
The Excel sheet probably would be included as one of those pages. Because the bottom line is that this is not a really difficult case. I mean, you need to tell me what your assumptions were in the Excel. You can't just give me an Excel sheet, right? You have to explain it, which takes a page or two. Or maybe you're going to use 2 Excel sheets with a page each or something along those lines. But when I said 2 to 4, I was pretty much including the Excel sheet as one of the pages. So, again, the amount of analysis is not extreme in this particular case. Now, let me give you a little bit of background on Destin. In other words, let me tell you what the problem is, okay, in case you missed that, right? What part of the course are we in again? Managerial accounting. Guess what the problem is? They have a managerial accounting problem. And here's their problem. And here's the problem that virtually every firm has everywhere that keeps track of accounting information. And I generalize this to every company at which I've ever worked, every company at which I've ever done consulting, and every company at which I will ever work or will ever do consulting. What they don't know is this. How much does it cost? It being their products. Not a company in the world knows what it costs to produce their products. Now, a lot of you are looking at me thinking, Bob, yeah, sure. Tell me IBM doesn't know what it costs. And I'm here to tell you, IBM doesn't know what it costs. GE doesn't know what it costs to produce their products. And we'll talk about why in today's class, at least for a little bit. Now, so the Destin case, the issue is, how much does it cost? It's a very simple case. They have 3 products, A, B, C. Obviously, that's not their name. And it turns out that the way they allocate overhead, so the issue with respect to overhead, or the issue with respect to cost, has to do with overhead. What is overhead? What do I mean by overhead?
It's like cost for the building the inventory is stored in, cost for
electricity, stuff like that.
Electricity, stuff like that. In managerial accounting, I'll do this over here, we generally break our costs. Notice in managerial we use the term costs. In financial we call them expenses. But we break our costs into 2 categories, right? Broadly defined.
indirect.
Okay. Direct costs, also known as what? Variable costs, right? And the other is indirect, also known as fixed costs. Now, how do we distinguish a direct cost from an indirect cost? How do we distinguish these 2 critters?
Direct cost is what goes into making the product.
Both costs go into making the product. And what you said is true, but not definitive.
Direct cost depends on how much product is made.
Okay? And the issue is, as the quantity goes up, what happens to the cost? For instance, if you're leasing a building and you produce 1 more unit, does your lease expense go up? The answer is no. Hence, leasing is an indirect cost or a fixed cost, right? On the other hand, material. If you produce 1 more unit, does it cost you more in material? And the answer is yes. Hence, material is a direct cost. Does that make sense? So, in managerial accounting, we broadly define costs and expenses as either direct or indirect, and the direct cost means that the cost goes up as quantity goes up. Conversely, the cost goes down as quantity goes down. Now, the indirect cost or fixed cost means that it's invariant, the cost per unit is invariant with respect to the number of units produced. Does that make sense? Now, most firms can do a pretty good job at collecting costs of one of these 2. Which one is it? Most firms do a good job either with direct costs or indirect costs.
Indirect.
Excuse me?
Indirect.
Excuse me?
Direct.
Direct. That's exactly right. Right? Most firms can figure out how much material goes into the product. They can figure out how much time from their workers was spent on either each product or each batch of products. They can get a good average. Right? But what not a firm in the world knows for sure is, how do we allocate indirect costs? For instance, let's go back to the issue of a lease. Suppose we have a lease for the building, right? And so we have this big blob of lease expense. And we produce 3 different products in our factory. How much of the lease goes to A, how much goes to B, and how much goes to C? How do you decide how much of that lease expense appropriately should be attached to A, B, and C? And the answer is, nobody knows. Right? Hence, we end up figuring out some allocation mechanism, and we simply allocate it down between A, B, and C. But what's the optimal, best way to do it? The answer is nobody knows. Let's get back to Destin. This is an example of what's going on at Destin. They are allocating, so I'm going to take this overhead down here. They are allocating overhead. And they're doing it, or so the case would have you believe, they're allocating it in a crappy way, right? And the whole point of the case is for you to develop a separate way to cost these things. And the way is called activity-based costing. Notice the acronym. You're getting your ABCs in this class, right? So activity-based costing, or ABC, is one method that firms can use or not at their discretion to help them allocate overhead. And it turns out in this case, the key to Destin Brass is for the firm to take a look at this activity-based costing method, which you have to design and implement as part of your analysis of the case, and then take that and figure out their new costs for A, B, and C. Does that make sense so far? So, if you decide to do Destin Brass, what do you have to do? The first thing you're going to have to do is come up with an activity-based costing system. And the second thing you're going to have to do is you're going to have to tell me why or how it helps. Does that make sense, everybody? So in this, right, again, what am I asking you to do? I'm asking you to create a statement of the problem. Well, I just told you what the problem was, right? You got to figure out the details, but I just told you the ballpark what the problem is. Then you got to figure out how to solve the problem. Well, I gave you a clue. It's your ABCs, right? But you have to go and figure out your ABCs. You have to do an analysis, and part of this analysis is how did we get our activity-based costing system, but more importantly is why? How does it help? Those are the questions that are going to distinguish the good papers from the mediocre papers. Questions?
Is there a due date on this?
Due date. It's due, I prefer to get it Wednesday after the last class. And the last class, I think, is the 23rd. It's the 24th. So your calendar?
23rd.
23rd. So I'd like to get this on, say, Wednesday the 25th, say Thursday, the 26th of April. And how will it be graded? Because I won't admit to including it in any particular way. And what I will do, if you decide to do this, it cannot possibly hurt your grade, first of all. If you do the work, it cannot possibly hurt your grade. If you're on the B-C range and you do this project and you do a credible job, in fact, if you show signs of life, you're in the B-C, I bump it to a B, right? However, if you're on the A-B line and you do a crappy job on the project, does it bump you into an A? And the answer is, probably not. I'll consider it for a small bump, but if you do a very good job on the project and you're on the A-B line, or even a little below that, let's say you're at the B plus level, that project can bump you from a B plus into an A. Again, if you do A quality work on the project. And A quality work includes answering the question, how does it help the company? B quality work, you figure out how to do activity-based costing. A quality work, you figure out why you want to do that kind of work and how it helps you make better decisions. Questions? Okay. Any questions about the class up till now, or what we're doing, where we're going? I want to take a moment or two to talk about current events. We haven't spoken much about current events. I think current events are pretty interesting these days. And one thing that we did in class that helps us understand a little more about how markets work is interest rates and present value. So what I thought we'd do is we'd talk a little bit about interest rates and present values and talk about what's going on in the economy. Now, when we did our interest rate, think back to the exam. In the exam, what we did was there was a question in the last exam which asked you for an internal rate of return and a net present value. And I gave you in the exam that the hurdle rate was 14%, or 14%. Now here's the question. Where does 14% come from?
Set by the managers.
Set by managers. How do they decide what the hurdle rate should be?
Cost of capital.
They use what's called the cost of capital. Now, what's the cost of capital?
The cost of investing the money.
Cost of getting the money.
Okay. We go back to our accounting equation. This is what? Assets equal to liabilities plus equity. And the cost of capital, we look at the cost of debt plus the cost of equity. Now let me go to the next page and we'll talk a little more about that. Turns out to be a very important topic in your financial savvy. So we have the accounting equation, assets equal liabilities plus equity. Quick review, what's on the left-hand side of the balance sheet? The toys, right? What we buy to help us create value. Property, plant, equipment, computers, receivables, inventory, crap like that. What's on the right-hand side of the balance sheet? How do we describe? We're describing it to our grandmother. What's on the right-hand side of the balance sheet?
Accounts payable.
Like the debt we have to buy our assets.
Okay. Where did we get the cash? The right-hand side is, where did we get the cash? The left-hand side is, what did we do with the cash? And it's as simple as that, right? The right-hand side is, where did we get it? Left-hand side is, what do we do with it? We invested that cash in things that create value for stockholders. Now, let's look at the cost of getting the cash. The cost of raising money from equity is lower than the cost of raising money for debt. True or false? Let me say that again. If a firm's going to go out and get cash, what rate of return do they owe the giver, call that the investor, and it could be an investor either in common stock or an investor in bonds, right? What kind of rate of return does it give the investor in common stock? That's the equity investor, right? Relative to what is the return they have to give to the liability holder, the bond holder, the debt holder. Does that make sense? Which one is higher? Equity requires a much higher rate of return. Why? It's true, but why?
Somebody who's going to buy an equity holding wants a return better than they could get by investing in
Why?
higher
There's
risk.
no
There's higher risk. There's a risk-return trade-off. That's key to understanding what's going on. Equity holders have higher risk. Why? Because bond holders have first call on assets in the event of bankruptcy. Equity holders are owners of last reserve. They're the residual owners. Okay, so equity is higher, liabilities are lower. Let's say that this firm has a 20% cost. In other words, before investors will buy the common stock, they require a 20% rate of return. And before bondholders will give us their money, if we're the firm, then they require a 10% rate of return. Okay, just to make sure. Does that make sense, everybody, so far? Now, what's the cost of capital? So the cost of capital is generally thought of as a weighted average. A weighted average of what?
Debt to equity.
Of debt and equity. Right. So it's a weighted average of the cost of equity and the cost of debt. How do we do the weighted average? The answer is it depends upon their capital structure. We look at their balance sheet, and we look at it and we say, oh, of all the money that they collected, 40% was collected from the liability side, therefore 60% was collected from the equity side. This is a trick question. Hence, the cost of capital would be equal to 40%, 0.4, times 10%, it's a trick question, plus 0.6, 60%, times 20%. Right or wrong? And the answer is no. Why? How do equity holders get a rate of return?
Dividends?
Two ways, right? One is dividends. The other is what?
Increasing stock value.
The price of stock goes up. Does the firm get a tax deduction for dividends?
No.
The answer is no. Does the firm get a tax deduction if the stock price goes up? The answer is no. For these liability holders who are investors in our corporation, call them bond investors, right? Do they get a rate of return, and what's it called?
Coupon.
It's called coupon or interest rate, right? Now, is that interest tax deductible? The answer is yes. Hence, if we finance with liabilities, we then get a tax deduction for that. Does that make sense, everybody? Hence, the after-tax effect of debt, we multiply the before-tax effect, and we subtract, or we multiply that by 1 minus the tax rate. Now, what's the usual tax rate that we use for most corporations when we do this kind of, again, financial intuitions we're working on in this class, day in, day out.
35%?
35% is a good federal estimate of the tax rate, but firms pay both federal and state taxes, right? At least, again, we're talking about U.S. corporations. So 34, 35% at the federal level. What at the state level? Depends upon the state, depends upon it. We should figure 5, 6%, right? So our tax rate's what? 40%. Reasonable estimate. If you don't know anything about the company, 40% is a reasonable first guess. Now, I did some work with Albany International last week, and the rate they use is 38% for their nitty-gritty calculations, but they use 40% when they're ballparking it in meetings. So, again, ballpark. It's about right. Questions? Now we get back to what's the cost of capital. And so the cost of capital here is, and let's actually calculate it. If we have a 40% rate here, 1 minus 40% is 0.6, right? 6 times 10 is 6%, times 4 is 2.4%. That's the after-tax effect weighted by the amount of debt. Plus 20% times 6 is 12%. So in this particular case, the weighted average cost of capital would be how much? 14.4%, and I used a 14% rate in the exam. Does that make sense to everybody? Now, obviously, or maybe not so obviously, but if we increase the amount of debt, let's go to another page. Any questions about this so far? So next question is, if we increase the amount of debt, so we have assets equal liabilities plus equity, and what we just did, just to remember, the 2.4 was this, plus this was 12%, gave us 14.4. Now suppose we increase the amount of debt. What happens to our weighted average cost of capital? Now keep in mind, how do we use the weighted average cost of capital again? What? Why is Boylan bothering you with all this crap? Because that's our hurdle rate. That's our risk-free hurdle rate, more specifically. That's the minimum amount we must make to justify doing a new project. It's the minimum rate of return we must be able to garner to justify making a new, or taking on a new project. Right? Now,
Why do you call that risk-free?
Well, I mean, because certain projects are much riskier than other projects. Call it low risk, not risk-free. Nothing's risk-free. But the low-risk problems have to have low-risk projects have to have at least a 14.4% rate of return. In this example, I mean, for instance, G might not use 14.4, some other number calculated in a similar way. But this is the basic idea.
And would you take that 14.4 and multiply a safety factor or something to get your real hurdle rate? Or you just pick that
Again, if it's a low-risk project, then 14.4 would be the hurdle rate. If it were considered to be a relatively higher risk project, then there might be some kind of a ratchet up effect, because with higher risk, we require what? A higher return, right? And that certainly is possible.
I have a quick question, maybe. If firms can use liabilities at 10% and then they're tax deductible, would it behoove the firm to max out on the bonds as much as they could as opposed to stock?
Okay, does everyone understand that question? And what he's asking is, shouldn't firms increase the amount of debt?
Vice equity.
As opposed to equity. Because what's going to happen, as you increase the amount of debt, what's going to happen to the cost of capital?
It's going to go up.
Excuse me?
Decrease.
As we increase the amount of debt, what happens to the cost of capital?
Yeah.
You're thinking right. You just
Right, okay, yeah, I'm sorry.
So the cost of capital will go down as we increase the amount of debt. Does that make sense to everybody?
But you have all those ratios to worry about. If you've got a lot of debt, then you don't look like a good company.
Okay, here's what you need to think about. And what you need to think about is financial risk. And financial risk has to do with a thing called leverage. And leverage has to do with what? The amount of debt. And the amount of debt is equal to what? The amount of liabilities, in this example right here. So what's going on is, the more debt that a firm has, the higher the financial risk is, because they have relatively higher leverage. Now, what's going on there? So now we have a firm that as they increase... Now wait a second, right? Think about this. What I just said was, as we increase the amount of debt, financial risk does what?
Increases.
It goes up. And yet the cost of capital goes down. Now why is that? I thought if risk went up, then the rate of return would go up as well.
Is the consequences of failing at a lower rate or more severe?
No.
Because if you're risky, then you'd be willing to take any project.
No.
Whereas if you're less risky, then...
Because you have to actually pay on your liabilities, you don't have to pay on your equity.
You're liable for that interest?
Okay, let's think about this now. We'll come back to that, since we're doing such a good job with it. Let's measure something that looks like this. If we measure the percent amount of debt, right? And this is 0% debt, right here. Now, we'll measure the interest rate right here. And the interest rate's a percent, right? Now, with 0% debt, we would be at the lowest interest rate. In other words, the first dollar that we borrow, we will have the lowest risk, and therefore the interest rate on the debt will be relatively low. And as we increase the amount of debt, what happens to the interest rate at which we can borrow?
It goes up.
It goes up. Now, does it go up in a linear fashion? And the answer is, for a while, right? But somewhere along this line, maybe it's 80%, maybe it's 70%, maybe it's 60%, depending upon the company, depending upon the industry, depending upon what stage of the business cycle you're in. All of a sudden, the perception of risk, and again, let's call that 70%, just to pick a number. All of a sudden, the market says, wait a second, that firm has too much risk. Therefore, what happens to the rate of return that debt holders will require?
Jumps.
Starts increasing at an increasing rate. Does that make sense, everybody? But the key thing is that the whole time debt is increasing, the cost of debt is increasing with it. Now wait a second. So now why is it again that even though the amount of debt's increasing and the cost of debt's increasing, how can it be that the cost of capital is actually going down as the cost of debt is increasing? How can that be?
You're replacing the higher risk for the higher return equity.
Because you're replacing high return equity with very low cost debt. And even though the cost of debt is increasing, it's still a great deal lower than the cost of equity, especially when you consider the tax-affected, the after-tax rate of return on debt. Does that make sense, everybody? So, to draw you another picture, boy, does Boyle like pictures? Doesn't Boyle like pictures? Draw a picture. To draw you another picture of leverage, or the idea of leverage, if we go from, let's say this is 0% debt. This is 100% debt. Oops. This is the amount of debt. Now, let's look at the example we started with, right? The example we started with right here. Now, if we have 0% debt, what's our weighted average cost of capital?
Cost of equity.
Which is how much?
20%.
20%. So in the example we've been doing all along, the cost of equity alone would be 20%. Right? Which is 0% debt, 100% equity. Does that make sense, everybody? Then as we increase the amount of debt, what happens to the cost of capital? And it comes down. But at some point, and again that magic point could be anywhere, all of a sudden at some point, the market perceives this company as having too much risk, and what happens to both the cost of debt and the cost of equity? They both start to go up. The market perceives higher risk, the market wants a higher rate of return, at some point the cost of capital starts to go up. And as the firm has relatively higher amounts of debt, notice that the cost of capital at very high amounts of debt can rise above the cost of capital with 0% debt. Because even though from the firm's perspective, equity is very expensive, debt can be very expensive when you have large amounts of debt. Does that make sense, everybody? So, now having said that, what's the answer to your question?
There's an optimal balance.
There's an optimal balance. That's right. So if you're a CFO of a company, what are you looking to do?
Balance it.
Trying to figure out where is my optimal cost of capital, right? What's my optimal amount of leverage? In this case, financial leverage. So that turns out to be a very important question. Questions about that? Does that make sense? Okay. So now, this has been a good review both of what we have done in the past and what we are doing right now. And the whole point is to then talk about interest rates a little bit. So now you have some background on the interest rates, right? The cost of equity, the cost of debt. We'll talk real numbers now about the cost in the market today. What I have is today's Wall Street Journal. So now I'm bringing in today's Wall Street Journal, and I want to talk about two different rates. I want to talk about the 10-year bond rate, which is this rate right here. Now, what page is this in the Wall Street Journal? The front page of the third section. The section is what? Money and investing section. That's where anyone who reads the Wall Street Journal goes to find out what their portfolio looks like, to find out what went on. Okay, so we're looking at bonds. And what I want to draw your attention to are two different pictures. One, the 10-year Treasury note rate of return, and the other is the federal funds rate below it. Now, since the beginning of 2000, which is about right here, what has been the general trend in long-term 10-year interest rates? What's the general trend? Well, you don't need a course in statistics to figure this one out, right? The trend is what?
Decrease.
The trend is down. So here's the question. What does that trend tell you? What does that trend suggest to you as a business person? Does that make sense, everybody? Okay. What does that trend tell you? Well, I'm reaming the poor guy in the back. You need to zero in a little bit better. Thank you. So what does that trend tell you? Generally speaking, when we analyze long-term interest rates, we draw something that looks like this. The long-term interest rate, the nominal interest rate, can be broken into two parts. What are those two parts? What are those two parts?
Interest.
Oh my gosh, he forgets the fact that he had me for business economics. He says,
No.
in fact, I wish I never took that class. Okay. The nominal interest rate can be broken into two parts. The real expected rate of return and the inflationary component. Now, historically speaking, the real rate of return is relatively constant. Hence, if the nominal interest rate is going up, what's causing the nominal interest rate to go up, usually? And the answer is people's expectations of inflation. Does that make sense, everybody? Now, what did we see in the graph? We saw a downward trend. Hence, what has happened over the past 15, 16 months? What has happened is that the expectation of inflation has come down. And with that expectation, long-term interest rates have decreased. Does that make sense? Now, like it's a little more complicated. It'd be nice if economics were so simple. And the guy in the back is going to hate me again. Because we're going back to this. So now I want to talk about the federal funds interest rate. Now the federal funds interest rate, notice the trend, but before we talk about anything, let's talk about what the federal funds interest rate is. What is the federal funds interest rate? What is that?
The rate at which the government lends to other banks.
A good guess would be the rate at which the government lends to other banks. Turns out that's wrong. But it's reasonable, right?
Banks lend to each other.
It's the rate that banks loan to other banks. So this is the lending rate from banks to other banks. Is it a long-term rate or a short-term rate?
Short term.
Short-term. How short?
Overnight.
overnight, 2 days, 3 days. Very, very short loans, short-term loans. Now, what does the federal funds interest rate tell you? Again, we talked about the long-term rate. The key thing it tells you is what? Inflationary expectations. It tells you a lot more than that, but if you only remembered one thing, it would be inflationary expectations. The federal funds market, again, if you only remember one thing, what does the federal funds rate tell you? It gives you a clue about what the Federal Reserve is doing in the short run. Or, it's called market conditions. In other words, do we have easy money or do we have tight money? Is it easy? Is there a lot of money in the economy, or is there a little bit of money in the economy? Now, talk real quickly about how that works. Leave it like that. No, you can leave it like that. If we have the interest rate, this is the federal funds interest rate, and this is the amount of money in the economy. What happens is we have some demand for money. This is money demand. We have some supply of money. The supply of money is controlled by whom? By the Federal Reserve, right? If the Federal Reserve wants to bring down the interest rate, what does the Federal Reserve do? It controls the money supply. Does it increase or decrease the money supply? It increases the money supply. Some new money supply, prime. And therefore interest rates come down. So when people are looking at the federal funds interest rate, they're looking at the change in the interest rate from I sub 0 down to I sub 1. Right? And they're trying to figure out, what is the Federal Reserve doing? Is the Federal Reserve increasing or decreasing the amount of money in the economy? Does that make sense? Now, if we go back to the picture, what's the Federal Reserve been doing? For a while, the Federal Reserve was doing what? If interest rates are going up, what's the Federal Reserve doing?
Decreasing.
It's decreasing the amount of money, making money more dear. The interest rate's the cost of money. As something becomes more dear or more scarce, the price goes up, right? Hence interest rates went up for a while. Then the Federal Reserve kept the money supply at a relatively constant rate of growth, at least in terms of the picture, right? However, since about Christmas time, what's the Federal Reserve been doing?
Increasing the money supply.
It's been increasing the amount of money that's available. Why? What's the Federal Reserve trying to do?
Keep from going into recession.
It's trying to increase the amount of cash and liquidity in the American economy to try to keep the American economy from going into a recession. Right? In other words, by lowering the interest rates, and these are the short-term interest rates, they are making it cheaper to borrow money. And what effect does that have on the cost of capital?
Decreases.
Brings the cost of capital down. As the cost of capital goes down, what happens to the number of projects that suddenly become attractive to corporations? The lower their cost of capital, the more projects they're likely to want to take on. They take on more projects, what happens to the number of people working? It goes up. Does that make sense to everybody? So the Federal Reserve, in an attempt to bring interest rates down, is increasing the amount of money availability in the U.S. economy. And that extra money availability is bringing interest rates down, lowering the cost of capital, and therefore, at least in theory, giving the incentive to firms to start funding relatively more projects, because now they only need to get a relatively lower cost of a lower rate of return. Their hurdle rate is coming down because the cost to get the cash has decreased. Does that make sense, everybody? Okay. So, very important lesson we just learned in accounting, right? And if you ever take a business economics class, at least if you take it from me, we'll spend probably 4 or 5 sessions talking about why these two things are so important. Because these two things are called monetary theory. And so what we just talked about was monetary theory, which has to do with the Federal Reserve. And we spend a lot of time talking about monetary theory in the business economics class. But for you as accountants, it's very important to understand a little bit about monetary theory because it directly affects interest rates. And the effect on interest rates to everybody in the economy is extremely important because it affects the present value. All right? So back to boiling 2 things. You learn 2 things in financial accounting that you guarantee to see in the final exam. What are those 2 things?
Present value.
Present values and what?
Cash flow.
Cash flow. Right? Well, interest rates are the link between present values and cash flow because we take the present value of the cash flow to get the price in the market, and the price depends on the rate of return that the investor requires. Does that make sense?
I have a question about the federal funds rate picture
Sure.
that you threw over there.
Sure. I'll redraw it for you.
Well, in the news, they said something like the Federal Reserve lowered interest rate by 1/4 of a point. But if you looked at that curve, that looked like it was steeper than that.
That's right.
So it translates, that 1/4 of a point translates to bigger things when it comes to...
Okay, did everyone hear and understand that question? Ram's question was that the Federal Reserve recently announced that it reduced the interest rate by 1/4 of 1%. 1/4 of 1%. And yet it looks like the federal funds rate went down by even more. How could that be? Does the Federal Reserve control the federal funds rate? And the answer is no. The Federal Reserve controls what's called the discount rate. And the discount rate is what? The rate at which the Federal Reserve loans money to member banks. So what the Federal Reserve did, it lowered the interest rate, the discount rate, by 1/4 of 1%. That then sent a signal to the market that the Federal Reserve was going to make more cash available. And the market then reacted in a way close to 1/4, right? The interest rate came down, but not exactly equal to 1/4 of 1%, right? Because the market sometimes believes what the Federal Reserve says, sometimes doesn't believe what the Federal Reserve says. Sometimes it thinks it's going to increase the money by even more than the Federal Reserve suggested. And it reacts accordingly, in a rational, at least theoretically rational way. So, even though there's clearly a link between what the Federal Reserve says and what happens in the federal funds market, the reason the federal funds market is on the front financial page of the Wall Street Journal is because it's a market rate. It's not controlled by the government. It's not controlled by the Fed. It's influenced by the Fed based on the amount of money availability, but it's not controlled by the Fed. It is banks loaning to other banks. It's what's going on in the market. And most individuals, including myself, think that a market-denominated rate of return is a much better signal about what's going on in the economy than anything the government will ever tell you. Hence, these 2 interest rates, the long-term rate to look at inflation, the short-term rate to look at economic cash liquidity conditions, turn out to be 2 of the most important things you should look at in the Wall Street Journal on a daily basis. Questions?
And it's not uncommon that the decrease in the federal funds rate could be twice or even 3 times that 1/4?
It could be much less or much more. You're exactly right. But the federal funds market usually reacts to what the Federal Reserve says. In the same direction, in the same general proportion. At least in the last 5 to 10 years, that's been the case. Questions? Okay, let's take a break here, and we'll try to take a relatively short break, and then we'll get going again at hopefully between 5 and 10 to 8. Any questions? Okay, see you in 5 minutes.